In this video, we're going to look at how to account for the disposal of plant and equipment. So once we dispose of or retire a depreciable asset, the cost of the property needs to be removed from the asset account, and then the accumulated depreciation would also have to be removed as well. So as an example, let's assume we have office equipment that initially cost us $20,000. Let's assume this $20,000 of office equipment is now being retired. It came to the end of its useful life, and it is now fully depreciated, and there's no salvage value. Well, in that case, the total cost of $20,000 would have been depreciated away, would have accumulated in the accumulated depreciation account. So at this point, what we would need to do is we would remove the accumulated depreciation account. So we would debit accumulated depreciation for the office equipment account. We'll debit that account for the full amount depreciated, $20,000, and we will credit the office equipment account to remove that asset off the books if it's now being retired. We'll credit office equipment for $20,000. So this is what the entry would look like to retire an asset that is, first of all, has no salvage value, and second of all, has been depreciated fully. So it's now being retired. So there's no gain or loss being recognized here. Now, what if we're disposing of a plant asset that we're actually being able to sell for an amount above book value? So let's take a look here. So we assume that a machine costing $10,000 had accumulated depreciation of $8,000 and a book value of $2,000. How do we get to that book value of $2,000? It's simply $10,000 minus the accumulated depreciation of $8,000, which gives us $2,000. At the time it was sold for $3,000 cash. So the journal entries record the disposal is as follows. So there's a couple of things happening here. So we know we sold it for cash. So our cash account here, that's going up by $3,000. So there's a couple of other things that have to happen here. So the machine itself, since we're selling it, needs to be removed from the books, and we remove that at its cost. So it's on the books at $10,000, so we have to remove that machine off the books for $10,000. The accumulated depreciation also needs to be removed from the books, and it has an $8,000 balance, they say. Okay, now we have to determine, is there a gain or loss on sale here? So to determine that, we say, okay, well, how much cash are we getting? The cash received is $3,000 versus the remaining book value. What's the book value? Well, the book value left over is $2,000. Here, we end up getting $1,000 more for this asset than its remaining book value. So here we can see there's $1,000 gain because we're getting more cash for this asset than its remaining book value. So we have a gain on disposal of plant assets here of $1,000. So there are a couple of things that we need to record here now. Not only the increase to cash, but the decrease to these two asset accounts, removing them, and then recording that gain. So we know we're getting cash, and we're going to debit cash here for the $3,000 received. Now, the machine, that we know this is a debit, but when we remove the machine, it's an asset account, we're going to remove it with a credit. Accumulated depreciation, remember this is a contra asset account, so it has an $8,000 credit balance, so to remove it we'll have to debit this account. And gain on disposal, this is going to be treated just like we would treat a revenue account. It's going to affect owner's equity, so we have an increase in a gain, so we're going to record that with a credit. So the only other debit here that we haven't recorded is the accumulated depreciation, so we're going to debit accumulated depreciation here for $8,000. and then we just have credits remaining. So we're going to have to remove that machinery off of the books here. We're going to credit machinery for $10,000. And then we're going to credit that gain on disposal of plant assets for $1,000 here. So we have 8 plus 3, that's 11. So 11,000 on the debit side and 11,000 on the right side, and we are in balance. So that's how we record getting rid of an asset and receiving more cash for it than its remaining book value. So you first need to make sure you're removing the asset and its accumulated depreciation, recording the cash received or the note receivable, and then record the gain or the loss on disposal of that asset. Now, what happens if we end up getting rid of an asset, but we end up receiving less cash for it than its remaining book value? How are we going to account for that on the books? So we do the same process here. First, we want to figure out, okay, how much cash are we receiving, so on and so forth. So here it says, assume that a machine costing $10,000 had an accumulated depreciation of $8,000 and a book value of $2,000, like before. But at the time it was sold for $500 cash, not $3,000 cash. So the cash we're receiving is $500. We have to, now we're selling it, right? So the machine has to be removed off the books. So that machine account will go down by $10,000. We also have to remove the accumulated depreciation account, and it has a balance of $8,000. But here, we need to determine gain or loss. Remember, the cash received here is $500 versus the remaining book value of $2,000. So when we compare the cash to the remaining book value, the remaining book value is $2,000, but the cash received is $500. So we're getting $1,500 less here than its remaining book value. So there's actually a $1,500 loss on disposal here. So we have a loss on disposal of $500 that needs to be recorded. So the cash going up, we know that's with a debit. Accumulated depreciation that needs to be removed is with the debit, right? Because it normally has a credit balance, so to remove it, we'll debit that. The machinery is a normal asset account, so to remove it, that would be with a credit. And this loss on disposal, a loss we treat similar to an expense, so increases in losses are recorded with a debit. So we have 3 debits here and 1 credit. So let's start journalizing this. So we're going to debit cash for $500, and we will debit accumulated depreciation for $8,000, and then we'll also debit this loss on disposal of plant assets. That's a loss of $1,500. And then we'll finish off that entry by crediting machinery for $10,000. So just like before, you remove the machinery and the accumulated depreciation account and you record the receipt of cash, but here there wasn't a gain recognized. Instead, there was a loss recognized here of $1,500. So it's important to calculate out the loss or the gain first and then start crafting your entry to determine what needs to go where.